Hi everyone, welcome back to our tax depreciation series, episode 2. In this episode, we'll quickly decode how depreciation works under MACRS, the method most businesses use for calculating tax depreciation in the US. Let's look at the steps to figure out depreciation under the MACRS system. First, choose your depreciation system, either GDS or ADS. Second, identify the property class and the recovery period. Thirdly, choose the right convention. Then check for section 179 and bonus depreciation. Lastly, apply the depreciation rate using the IRS MACRS table. Now let's begin with the first step. We start by choosing the depreciation system, that is GDS or ADS. So GDS is basically General Depreciation System, which gives faster depreciation with shorter recovery periods. And ADS is Alternative Depreciation System, which uses straight line depreciation over longer periods. So there are 4 depreciation methods, 3 under GDS and 1 under ADS. Start at the top by choosing the depreciation system, either GDS or ADS. If you choose GDS, you have 2 accelerated options, the 200% declining balance or the 150% declining balance method. Both provide higher deductions in the early years. Eventually, each of these methods switches to straight line once it results in larger or more balanced deduction. If instead you select ADS, the system uses the only straight line method, spreading depreciation evenly but over a longer recovery period. Now let's talk about property class and recovery periods. The property class defines what type of asset you're depreciating, for example, machinery, computers, or buildings. The recovery period tells you how long you'll depreciate the asset. Under GDS, there are 9 main property classes ranging from 3-year property for short life assets to 39-year non-residential buildings. Under ADS, recovery periods extend from 3 years to 50 years, making it the slower system overall. The next step is to choose the right convention. This tells you when depreciation starts. There are 3 key conventions under MACRS. First, mid-month convention, which is used for real property such as residential or commercial buildings. Depreciation begins at the middle of the month the asset is placed in service. Second, mid-quarter convention, which is used for personal property if more than 40% of the total assets were placed in service during the last quarter of the year. Third, half-year convention, which is the most common one. It assumes all the assets were placed in service halfway through the year, giving half a year's depreciation in the first year. Finally, before applying MACRS, check for section 179 and bonus depreciation. Both allow larger upfront deductions before regular depreciation begins. That is, subtract any section 179 or bonus depreciation and then apply depreciation rate using IRS MACRS table to what's left. That gives your MACRS depreciation deduction for the year. And that wraps up our walkthrough of MACRS depreciation. This is EXPDecode, simplifying global tax and accounting concepts, one episode at a time. Thank you.